today I'm going to talk about a practice management topic that I love to hate or hate to love, client segmentation. It's one that we talk a lot about in the practice management arena, and it's one that I think we spend a lot of time emphasizing the wrong things for advisors, and I want to talk about that today. Most advisors that I've spoken to have gone through a segmentation exercise or multiple segmentation exercises at some point throughout their career. They spent an inordinate amount of time actually segmenting, coming up with some special formula that's going to divide their clients into AAA, A, B, Platinum, C, D segments, and that supposedly is going to be the foundation of the business. And what ends up happening, because the business is so fluid and it's changing so much, and the margins on the business is changing so much, I've seen a lot of teams have segments, have those tagged within a CRM system, but then still feel like, number one, they're giving relatively similar service to all clients in all segments, and B, they don't really have a good fundamental understanding of whether the way they've segmented is right and is profitable at each segment. And so I'm going to make some general statements. The sort of core of this is, now is the time to not just analyze your entire book of business, but to analyze how new business coming in and the households that you've brought on have impacted segments and profitability at each segment. So that's going to be a really important exercise that I think all advisors should do sometime before year end. Okay, so I almost want to call this video the realities of client segmentation, because I want to talk about what really needs to happen for a segmentation strategy to be effective in a business and poise the business for continued growth, profitable growth. The first thing is that segmentation means absolutely nothing without a strategy to scale an abundance of new business. And I don't think we talk enough about this. We're obsessed with how to categorize the names of the segments and what to call them. The truth is that if you are in growth mode and you have 100 plus clients, or let's just say more than 100 clients, and plan to bring on 100 clients, and I use 100 because an individual advisor who is focused completely on interacting and serving clients cannot serve more than 100 relationships. And within those 100, I would say realistically, there's 20 to 30 that are super sort of comprehensive, deep relationships, and sort of the rest tier down. So automatically, this video is probably relevant to everybody watching. If you do not have a plan to scale the bottom two tiers of your book of business, then it doesn't matter how many times you segment or resegment. There are three, and perhaps there are more, but there are three sort of ways advisors segment. The first would be the 4-tier strategy, which we're all familiar with, right? 20 to 30 clients, 40 to 60, 60 to 80, and then, the rest sort of fall in that D category. Then there is the 2-tier approach, where we have our top A+ ideal type of clients and everybody else. And then we have the third strategy, which I would say is really for businesses that are established and that have created a service model where there are multiple advisors serving various segments or various groups of clients, and we'll call that the all A strategy, right? Everybody's a top client, everybody is at that, above the minimum, and we have multiple advisors serving those clients. Most advisors' books of businesses are reflective of, the first or second sort of segmentation approach. No matter what anybody tells you, if you're the senior advisor, if you're the primary revenue generator in the business running that 4-tier strategy, you absolutely have to have a very different service model for C and D, or the bottom two, than you do for the top two. And so what I encourage advisors to think about is not even what constitutes a B versus a C, but do you have the ability to create automated and in some cases reactive service for the bottom tiers? Meaning, do you have an associate advisor on staff that can not just answer emails and service those accounts and households, but that can hold review meetings and investment reviews for those bottom two tiers? Do you have access to a robo offering, perhaps, let's say the client has an insurance product or is a brokerage client, but is a do-it-yourselfer for whatever reason or has a small account. Is there an option for you to allow that client to get automated sort of investment service while you're maybe doing the planning or servicing the individual product that they have with you? Do you have the ability to pass those relationships on to somebody else? And do you have the ability to charge for services uniquely for those bottom tiers? One of the recommendations that a coach or consultant might make to you is that clients who fall below the investable asset minimum that you may have established in your organization should be paying a subscription fee or advice fee. So, maybe it's something as small as, $250 a quarter, or maybe it's more than that, but are paying so that they can have a relationship with a human advisor while getting the rest of their needs met in sort of a digital format. Without any one of those strategies, continuing to grow a business as a solopreneur advisor with maybe one or two people under you with the ABCD segmentation strategy is simply not going to work. You're going to hit capacity no matter how many certified or licensed associates or assistants you bring on. So you need either an advisor that can service those accounts from a review meeting standpoint, or you need to find a way to generate enough revenue from that lower tier that it substantiates them having a relationship with you or somebody else on your team. So that's the first thing. The second thing I'd say is that we get really, I've said this before, obsessed with, criteria and what constitutes, certain clients within certain segments. I believe that is becoming less and less important. Psychographic data, information about, client characteristics that connect them to other clients in that segment that's going to dictate the way in which you put out content to them and run review events for them. That is becoming more and more important. So for most advisors who have a business where there's other professionals and advisors underneath you, I want you to start thinking more about, look, we know that clients have to generate a certain amount of revenue, and we need to understand roughly what that revenue tier is within each segment. So maybe our top clients generate a minimum of 10,000 in revenue a year, and our second tier are between 5 and 10, and everybody else is underneath that. But what's more important is that within those segments, we've tagged clients in our CRM based on the things that we know are important to them, or things that really define them as a client. So, we've got our, perhaps it's retiree clients. These are clients who, we know are going to be available at certain times of the day for certain events because, they're retired. They're clients that might be interested in certain types of topics and commentaries because they're in that specific age bracket. We have our clients with kids. We have our clients who are incredibly charitably inclined and care about impact work. We have our clients who get paid in, equity-based compensation. So these are all things that can help us curate an experience for those clients using content, and that's a whole other conversation, but use content and, special sort of surprise and delight things that we do for them. That is much more important than, coming up with a strategy that's going to determine, based on points, exactly where somebody should fall in the various segments. So again, my recommendation is have an understanding of the revenue tiers that reflect whether somebody's a top client, maybe approaching top client or not. And then start tagging and creating communities within your client base based on things that connect those people and characteristics that sort of make those clients unique. The other thing I'd say is that don't reinvent the service wheel. I see advisors do this all the time. Like, what service are we going to give to clients? Look, there's basically 3 ways in which advisors engage with clients. The first is what I call the professional sort of way, right? The business oriented way, meaning review meetings. That's where you have set time, you meet with a client, you talk to them about their financial plan, you talk to them about what's going on with their investment accounts and their policies, and you give sort of an overall update on them and their situation. Then there's sort of the personal service. That's you being proactive about staying ahead of clients as it relates to things like their taxes, RMDs, things they need to keep top of mind. And that also encompasses the way in which you respond to them, right? So if a client emails you, they're a top client, they immediately get a response back, even if you don't have the answer. And then there's the third way, and I'll call that the surprise and delight, the experience sort of service. Content they get, special gifts that you send them, moments that you recognize, events that you put on for them. So that's it. We know that top clients are going to get more review meetings. Top clients should get 2 to 4 reviews a year, depending on the complexity of the plan and the way in which you serve and service them. Lower tier clients are going to maybe get an investment review call or 2 phone calls instead of in-person or Zoom reviews a year. As far as the personal service, you can play with the way in which you deliver that. For your top clients, you may have a set meeting with an accountant every year for those clients, and maybe there's 10 people you do that for, and for everybody else you don't. There are other ways in which you can sort of play with that personal service. Top clients get a response within an hour. Maybe your lower tier clients, that gets pushed to, a service at Journey SW email, and, clients get the team to step in and respond versus the senior advisor. And then with the surprise and delights, there's a ton of ways in which, lower tier clients may not get surprise and delights. Your top clients, the 50 who fall within that top and maybe middle tier, I know I said 2 tiers, but maybe it's 2.5. Maybe they will get every special moment and milestone recognized. Maybe they'll get a year-end achievements list where you list out all of the things they've accomplished in their careers and with their families and with you as their advisor. That's something that is, could be saved and done specifically for top clients. So my point is, don't reinvent the wheel and overthink this. Okay, that was a lot. I hope that was helpful and got you thinking. Reach out if you want help thinking about segmentation. And I will see you soon next week. Same place, same time. Take care.